Welcome back, everyone. So today's explainer is tackling something that actually affects nearly all of us, but from a totally different angle, one you might never have even considered. We're looking directly at the SASB standards for the mortgage finance industry to uncover what is essentially a hidden threat. Now, if you know SASB, you know these standards are the absolute gold standard for corporate sustainability reporting. Wall Street takes these risks incredibly seriously. We're going to break down exactly how abstract, physical climate events actually translate into very real, measurable financial risks for lenders and, well, for borrowers too.
Let me ask you a question right off the bat to frame how we're thinking about this. What actually happens to a mortgage when the collateral literally washes away? To most of us, right, a house is a family home. It's a place of safety, a place for memories. But for this explainer, we need to shift our perspective just a bit. To the mortgage industry, that house is strictly collateral. It's just the underlying asset backing up a massive financial agreement. So when a natural disaster strikes, it isn't just a physical tragedy. For the banks, it's a profound financial shockwave.
Okay, let's dive into this. The SASB framework lays it out incredibly clearly. An increase in the frequency of extreme weather events, things we associate with climate change, like severe hurricanes and catastrophic floods, well, they directly threaten the mortgage finance industry in three very distinct, undeniable ways. They cause missed payments, they trigger massive loan defaults, and they lead to drastically decreased underlying asset values. That is the core thesis we're unpacking today, and it comes straight from the industry's own sustainability accounting standards.
Part 1. The hidden climate threat.
So we're going to map out the exact direct path from a physical weather anomaly to a full-blown systemic financial disaster. Honestly, think of this process like a devastating domino effect. Step 1 is the extreme weather event itself, the severe storm or the flood making landfall. Step 2 is the resulting property damage. When a home is severely damaged, suddenly families are burdened with massive repair costs, or maybe even total displacement. And that leads directly to Step 3, missed payments and delinquency. If borrowers are draining their life savings just to rebuild or rent temporary housing, they often just can't pay their mortgage. And finally, we hit Step 4, loan default. The borrower simply cannot recover, the monthly payments stop entirely, and the lender is left holding the bag on an asset that might now be completely ruined. Which brings us to Section 2, Asset Value in Danger. Now that we understand that chain reaction, we really need to know what actually triggers it. The SASB standard specifically categorizes these threats into three distinct buckets of weather-related natural catastrophes. First up, we have meteorological events, think hurricanes and severe storms. Then, hydrological events, which basically means floods. And finally, climatological events, such as extreme heat waves, droughts, and devastating wildfires. Now, it's absolutely crucial to note what is explicitly excluded here. The framework separates out geophysical events, so things like earthquakes or volcanic eruptions aren't in this bucket. We are focusing purely on weather and climate-driven catastrophes that are growing in frequency. And this brilliantly illustrates exactly how the industry standardizes this massive problem. If you look at the official SASB Sustainability Disclosure Topics and Metrics table, there's an entire category explicitly dedicated to environmental risk to mortgaged properties. This accounting framework is basically the industry's structured solution for exposing and measuring these hidden villains. It forces lenders to pull these risks out of the abstract and slap hard, standardized numbers on them. It's literally no longer acceptable to just call a storm an act of nature. In the financial world, it is now a highly measurable risk factor. Moving on to Section 3, Tracking the Financial Fallout. It's one thing to acknowledge that extreme weather causes risk. It's another thing entirely to actually measure it. The first key metric here is known in the standards as FM F450A.1. This rule actually requires banks to track both the absolute number and the total dollar value of mortgage loans that are sitting right inside 100-year flood zones. Now, what does that mean? These are land areas subject to a 1% or greater chance of flooding in any given year. We're talking coastal floodplains, areas along major rivers, or low-lying ponding areas. By publicly reporting this data, lenders are basically showing investors and regulators exactly how much of their portfolio is sitting directly in harm's way, just waiting for the water to rise. Next up, we encounter some professional jargon that is just vital to understand: loss given default, or LGD. This comes straight from metric FMF 450A.2. LGD is simply the share of an asset lost in the situation of default. Think about it. If a borrower defaults because a massive flood wiped out their property, the bank isn't just missing out on monthly payments, they now own a severely damaged asset. Loss given default measures the actual percentage of that loan's value that the bank expects to lose entirely. It puts a precise, undeniable price tag on that physical devastation.
Alongside LGD, the SASB standards also demand that lenders calculate and disclose what's called their expected loss. And this is the sum of the values of all possible losses, each multiplied by the probability of that loss actually happening. And importantly, this is a big deal, lenders must break this data down by geographical region. I mean, a hurricane in Florida poses a fundamentally different financial probability than a huge wildfire in California, right? This geographic breakdown forces ultimate transparency. Investors can look at the data and see exactly where a bank's highest risks are concentrated across the map, making sure no major vulnerability is just hidden away inside some broad national average.
Section 4. Rewriting the underwriting rules. Tracking the current damage in a loan portfolio? Well, that's really only half the battle. Banks also have to adapt their future lending practices. So the crucial point here is this. Lenders can't just react to the weather after the fact anymore. Metric FNMF 458.3 requires a narrative description of exactly how climate change and environmental risks are being incorporated into mortgage origination and underwriting. They literally must proactively bake environmental risk into their origination models well before they even approve the loan or hand over a single dollar to a prospective buyer.
So what does this actually look like in practice? Well, it fundamentally changes how loan origination works. First off, banks might adjust the initial valuation of the collateral purely based on its location's inherent risk. Second, they might actually sit down and assess whether the property has basic adaptive measures already implemented. We're talking things like hurricane shutters or structural reinforcements, before finalizing any terms. And finally, and this one is massive, they must factor in the credit risk of borrowers who are uninsured or underinsured against these specific natural disasters. Because if a disaster hits and the homeowner doesn't have adequate insurance to rebuild, the likelihood of default absolutely skyrockets. Banks now have to calculate that exact vulnerability right up front. As we wrap up this explainer, I really want to leave you with a final thought to ponder. As the climate shifts, is your local mortgage lender calculating the true cost of the storm? The next time you see footage of an extreme weather event on the news, remember that the impact doesn't stop at the waterline. It ripples outward, fundamentally altering the economics of homeownership and the stability of the entire global mortgage finance industry. Thank you so much for joining me. Keep asking the right questions, and I'll see you in the next explainer.